Good afternoon, everybody, and welcome to our BDO webinar. My name's Sophie Michael, and I lead the retail sector at BDO. This webinar is very much focused on providing insight on tax aspects for retailers as they navigate not only through the challenges of COVID, but also as we approach the exit from the EU. I'm going to be followed by my experts at BDO, who are far more knowledgeable than me in tax, and they will be speaking on the various aspects of tax in the context of COVID and Brexit. First of all, I'm going to be followed by Håkan, who is a specialist on customs and international trade, and he'll bring his views on not just the challenges, but also the opportunities that lie ahead. Then Martine will follow with indirect taxes, and again speaking in the context of COVID and Brexit. And then finally by Julia, one of my international tax and transfer pricing partners, and she'll be talking about tax and how businesses can manage through this in these turbulent times. But before I pass on to Håkan, I just want to have a look at current trading. And I'm going to look at this in reference to the BDO High Street Sales Tracker. Now, for those that are not familiar with this tracker, this tracks like-for-like sales on discretionary spend. We focus on fashion, lifestyle and homeware. So this tracker is not distorted by essential spend, and in particular supermarket spend. What this graph shows is the total like-for-like tracker across all channels and also the non-store channel. This isn't showing, we very much moved to a total tracker because of lockdown, but what I will say is that in September, in-store like-for-like sales, or rather August, sorry, fell by 28%. Now, that is the lowest drop that we've had in comparison to last year since lockdown. But actually, it still shows that over a quarter of spend in store has been wiped out. When you look at that total tracker along the bottom, it has improved, and it improved in August, but again in the first 2 weeks of September. But the real question is, how is this really sustainable? And actually, the big concern is that whilst furlough has protected jobs throughout lockdown and up to now, when it comes to an end next month, the real concern is the rise in unemployment. And what does this mean in terms of the consumer person spending? So there's a real call on the government in terms of continuing relief for the retail sector. The green bluish line is the non-store like-for-like, and you can see how that shot up and that channel shift following lockdown. And in fact, this has continued, and this increased again in the last few weeks of August. So before I turn to Håkan, I just want to remind ourselves on the next slide of the key trends that we were seeing in retail pre-lockdown, and which will continue to be the key trends which differentiate those successful retailers. And whilst there is those immediate priorities, I just want to highlight these again because these will continue to be critical. The new consumer landscape and really understanding your consumer. Before COVID, it was the focus on that grey pound and how many retailers are really focused on that grey pound. But I would again focus this and say, have the retailers really understood that channel shift in their customer, and this older customer now, how much more they're spending online? The convenience and affordability, which is becoming even more important and critical as unemployment will rise and the tightening of the consumer purse, but also convenience. And today I saw that Aldi had announced that they're going to trial a click and collect service. So whilst convenience used to be having that local store, and perhaps we're returning to that, it's very much the consumers looking at having everything available at the tap of a button. Health and wellness, the more you give the consumer information, the more they desire to know, and COVID has only continued to increase that. Sustainable and ethical, and this is a necessity, and we see what this does to retailers who have bad press coverage in this area. And it's not just the consumer or the communities those retailers sit in, but also the investor community. And lastly, smart and connected, how retailers will use technology, not only in terms of how they're engaging with their customer, but also internally for their business models. And all of these themes continue to really fall into two categories. The first being the consumer and how the consumer is changing, really understanding that. And the second, technology and how technology is changing the channels over which the consumer shops, but also their own business model and the efficiency within their model. So finally, the pressing issues for all retailers is really cash flows, focusing on cash flows, managing risks and really understanding the risks ahead with no surprises. And thirdly, being Brexit ready. And that's a good segue into Håkan, who's going to speak more on that subject.
Right, thank you very much, Sophie. Welcome, ladies and gentlemen, to this little bit here about customs in the context of the retail industry, and especially in the context of, as Sophie said, the cash flows and risks. Customs is really one of these topics that touches everything that has to do with the movement of goods. And so, as you know, getting the goods into the UK and getting the goods out of the UK involves customs. And it involves customs cost and compliance matters. And so in these days we are now with COVID and with the Brexit transition period coming to its end, we thought it was really timely to talk a little bit about where we are now, what challenges the retail industry is facing. But as Sophie said, also a little bit, what can you do? What do we advise you to do? What can we help with? So if we start with just a bit of the bigger picture, where are we now? So as you can see from this slide there, we have a timeline, last year, this year, next year. We are now coming towards the second half. We're in the second half of 2020, Q3. We had collectively, I think, as a country, expected that by this time we would have progressed rather far with the UK-EU trade deal talks, and that we would have a trade deal that is lying, waiting for us already on 1st of January. That doesn't seem to be the case. It's not something that I think we can rule out, but it looks less and less likely that we will have that trade deal. So I thought it's interesting to talk about what does that mean then for you as retailers. If we have the deal or if we don't have that deal, what consequences will there be there for your cash flow and for your risks? And I think if we kind of disseminate that slide a little bit here, the first thing I would like to point out is that you'll see from the timeline that when we come to 1st of January 2021, from that point onward, it will be required to have a customs declaration for goods coming in from the EU into the UK for many products. Not all products, because as you see the next point there, the next deadline is the 1st of July 2021. At that point, all products that move into the UK from the EU will require a customs declaration. The reason why there is a bit of a 6-month honeymoon there is because it's just difficult for traders to adapt quickly to these new circumstances, and So the government and HMRC is offering this option of deferring that declaration for up to 6 months. But to summarize, whether it's on the 1st of January or 1st of July, there will be a customs declaration needed for goods moving into the UK. And likewise, not to forget, there will also be a customs declaration required for moving goods out of the UK. That is the case today when you move goods out of the UK to outside the EU, but we will have that requirement also for goods moving from the UK to the EU. And that is regardless of who that customer is. If that is a consumer or another business, there still will be need to be made a customs declaration. So that's about the timeline and what you can expect. So what does that then mean for you as retailers that you have to make that customs declaration? On the right hand there, I've just broken down what are the consequences for you. Well, you can group it into two types of consequences. You have a cost associated to that customs declaration, not only for making it, the administrative cost, but most of your products will be dutiable. So moving goods in from the EU to the UK will trigger a customs duty liability. So that's one thing. Now the duty is typically 10 to 12% for most retail products. So it's a sizable cost, and customs duty is not recoverable as opposed to VAT. So it's an actual cost. So that's one thing to remember. There will be a cost for most of you that you don't have today for goods coming in from the EU into the UK. And the second point I would like to make, I've already hinted to, the administrative burden. So that is associated to the actual fact of making the declaration and the fact that the goods coming into the country will be subject to the same kind of checks as currently goods coming from outside the EU into the UK. So there is that same risk for delays in the supply chain for goods coming from the EU going forward as you have today for goods coming from outside the EU into the UK. And there's one more thing I would like to point out about that. When we talk about the export and import declaration, you might be asking yourself, who is supposed to make those declarations? And that's a really important question. And you may have customers in the EU where you haven't had that discussions with yet. And I would urge you to have that discussion with your customers and suppliers in the EU, because someone will need to make that export and declaration, someone will need to make the import declaration. If that is not clear when we come to 1st of January, then you have potential risk for delays in the supply chain. So if I can then leave that for now and move on then to what would I suggest that you look at? And there are many things to look at, but I try to just point out the 4 key things that I think is worth putting on your agendas. Mind you, this is not much time left until 1st of January. So this is definitely something that if you haven't had the discussions internally yet, then you should really talk about these things now. So the first thing I would say is look at your supply chain, and Martin will later talk more about mapping of supply chain and why that is important from a VAT point of view. But from a customs point of view, that's also really important to understand where are the goods coming from when they go into the UK, and where are they made? What is the country of origin? Because that is important when we talk about free trade agreements and whether you're able to claim a lower preferential duty rate for those products. So mapping the flow is really important. And there's potential cost savings to be had here. Now, when I say cost savings, is typically not compared to today's situation, because today, of course, you're not paying any duty for goods coming in from the EU. So it's more about cost avoidance, perhaps, than cost savings. But nevertheless, it's important to minimize any additional costs in the supply chain that you or your customer or your supplier will have to bear. So what opportunities are there? Well, just to mention one, so a few of my clients are bringing in retail products into the UK as a central warehouse for their Europe or even global operations. If you bring in goods to the UK, and at the time you bring them in, you're not sure if they're going to stay in the UK or if they're going to go to the EU or the rest of the world, well, then you might want to look at something like a customs warehouse or inward processing relief, which allow you to suspend the payment of the duties. And if it turns out that the goods are actually not staying in the UK, but they're being re-exported to customers outside the UK, then you don't need to pay the UK customs duties. You avoid a double dip in the customs duties. So that's just one example. And as I said, some of my clients are already have set that up, or they're in the process of setting that up. So looking at another point, I move down to the box underneath there, quantify the effects of the customs duty cost. Well, today we are operating under an EU tariff. So it's the same tariff, the same customs duty rates for EU and the UK. But after 1st of January, UK will have its own tariff. That will differ slightly from the EU's tariff. So it's important to have a look at that and see what can you expect. There will be some winners and some losers in this. If you are currently importing goods from the EU only, not from the rest of the world, well, then you will have additional cost, as I said earlier. But if you're bringing goods in exclusively from outside the EU today, say from China, the US, into the UK, well, then chances are that the UK tariff is going to be slightly lower than the EU tariff for your particular products. So you might actually benefit from this. It might be not an additional kind of cost to consider, but it will be a reduced duty rate. So looking at what does that UK tariff, what will that mean for you is really important. And of course, we can help you with all of these things. Thirdly, safeguarding supply chain. So once you figure out where your goods are coming from and moving to, then try to make sure that your goods are not getting stuck in customs, because it will affect you or your customers negatively. So trying to safeguard that, and that includes things like potentially getting an authorized economic operator certification and authorization. That is about reducing the risk profile that you have as a company, as an importer with HMRC, so that the goods can move quicker across the border, less risk for your goods and your paperwork to be held for inspection. But there are other things you can do too. So looking at your commodity codes and your declared customs values and your country of origin, all those data points that you need to declare on the customs declaration when the goods come into the UK, all of those points are also what HMRCs are looking at. And of course, if they see something that they feel is not quite right, then that is a potential delay, a potential interruption in the supply chain. So it's really important to look at these things before 1st of January and have the house in good order. And finally, the fourth point is about upskilling internal capabilities. Today, you might be asking freight forwarders questions, and we know that freight forwarders are going to be really, really busy. HMRC expects 5 to 7 times as many customs declarations to be made after 1st of January compared to today. So rather than relying on third parties, I definitely recommend that you're upskilling your own internal workforce, both management and operational staff. There's something, again, we can help you with. But mind you, currently, you can get a grant for that will cover your cost for training. So again, something worth looking into. It's not only if you're planning to make declarations yourself, but it's also worth having training if you are using a third party, because you really need to be clear about what the rules and regulations and requirements are. If you don't know that, then it's going to be very difficult for you to make sure that your agent is doing a good job for you. And HMRC will hold you responsible as importer, even if you use a third party. So that is really what I wanted to cover. So again, just recapping, there are things you can do now. There are certainly things that we cannot foresee how they will go, but these are 4 simple things, 4 areas that I think you need to look at. And again, we're quite happy to help you with this. So I think with that, I'll hand over to my colleague Martin.
Thanks, Håkan. So I'm a VAT director in the BDO VAT team, and what I'm going to cover today, I'm going to have a look at COVID and talk about cash flow. And I'm also then going to move on to Brexit. So what do retailers need to start thinking about as they move towards the end of 2020 and into 2021? So starting with COVID, it's been a very interesting and quite challenging year for retailers. We've seen quite a lot of change already with regard to obviously the early COVID days and lockdown, whereby a lot of the retail stores were closed for long periods of time, and a change really from bricks and mortar retailing to maybe a little bit more online retailing. So it was quite interesting to see actually how quickly the government acted and how they did think about VAT in particular with respect to cash flow. And as you will all remember, there was the introduction of the VAT deferment period, for which businesses could not have to pay their VAT payments between March and June 2020, and not have to meet that the VAT requirement for the paying of that debt until March 2021. The interesting thing in the conversations that we've been having with a number of our retailers around this was obviously the fact that this helped greatly during those earlier periods whilst we were still trading and we were still collecting the VAT. But actually in some cases, the VAT that was collected from the consumer was used actually to keep the business going during those difficult times. So as we look forward and as we move towards the 31st of March deadline, it'll be quite interesting to see how retailers and other businesses are going to meet that the VAT debt that they owe HMRC. As I say, some of the conversations that we've been having with our retailers at the moment is to try and plan and try to schedule those payments. There's no requirement to agree with HMRC when you're going to make payment for the outstanding VAT debt, but it's very, very clear in respect to the conversations that we've been having with HMRC around that, is that they do expect the debt to be settled by the end of March next year. One thing to watch out for is if you're not going to be able to make the payment but by next year, you need to start thinking as soon as possible about time to pay arrangements. So when we were heading towards COVID and we didn't know that COVID was going to hit us, it was quite interesting to have conversations with retailers around cash flow. And even at that time, some of the clients that we were speaking to were already thinking about time to pay arrangements as they were starting to stockpile for Brexit, for example, and using the VAT cash that had been collected for that. So some very interesting conversations with HMRC pre-COVID around trying to negotiate time to pay arrangements. Interesting point is that they still do expect your VAT debt to be paid, and that VAT that's collected from the consumer to go towards the Treasury. So we've had some very interesting conversations around some of that money being used for other parts of the business just to keep the business going, and HMRC being quite strict around schedules and time to pay arrangements. So just a word of warning, if we are looking at a time to pay arrangement, HMRC are getting a little bit more stricter around that. They are accepting that COVID and the move to Brexit is putting a lot of pressure onto businesses, but we really need to start thinking about trying to negotiate an agreement with HMRC sooner rather than later on that. So yeah, definitely worth having a think about if you think you're going to struggle come next year. So obviously cash and VAT always go hand in hand, and if you're able to mitigate any output tax that you might pay or increase your input tax that you can claim, that can have an effect on the bottom line. So some of the work that we've been doing with our clients has been around some of these general housekeeping cash flow opportunities that have been around for a long time. So all I would say to you guys is that don't forget some of the simple things, because it can make a difference with regard to cash. So a couple of areas in particular, particularly relevant with regard to the COVID situation. The first one's really around payments on account. So if you are a large payer, you might be making payments on account each month, and when you do your quarterly VAT return, you'll make a balancing payment. Now, typically, those payments on account are set based upon last year's trading. So obviously nobody could predict what was going to happen this year with COVID. Nobody was going to predict potentially the massive drop in trade that we've seen over the last 6 months. So one thing that I would always recommend is that if you do make payments on account and they are currently based upon last year's trading, one thing that you can do is have a look and try to negotiate with HMRC, either that you fall out of the payments on account regime, or that your payments on account this year maybe should be based upon actuals. So agreeing with HMRC that you can make those monthly payments based upon current trading patterns. So again, how can that benefit you guys? It will benefit you in respect of the cash flow benefit if you're able to reduce the payment that you're making on those 2 months during the VAT quarter, and instead maybe only having to make one payment at the end of the quarter, or making reduced payments. Now it's quite interesting, isn't it? So for some of those earlier COVID periods, trade may have dropped significantly whilst your costs would remain quite high with regard to the initial stage with regard to landlords, rent and things like that. So you may have found yourself in a repayment situation for a couple of those earlier periods. So definitely worth looking at, and it can definitely bring cash into the business. The second point on the slide is bad debt relief. Now, for retailers on the output tax side, it's not such a big issue, because typically you would get paid for the goods before you sell the goods or you deliver the goods to the consumer. However, on the purchase side, it's just one thing to watch out for. So under the bad debt relief rules, there is an automatic requirement for you to adjust your input tax if you haven't paid a supplier within 6 months. So just a word of warning, just be careful in respect of any of those purchases if they remain unpaid during these tough times. The third area on the side is just, again, basic housekeeping around VAT recovery. So this is around making sure that you are recovering the VAT on your purchases at the right time, and you've got appropriate evidence to do so. So in the past, we've looked at areas with retailers around, sometimes you might not get a proper invoice, for example, from the landlord for the rent. You might get a request for payment. And if you operate a number of retail outlets, it might be quite an onerous job really to keep calling and chasing up that purchase invoice. So a good example of HMRC being quite flexible around VAT recovery is that in a couple of occasions, they have agreed recently that businesses can use alternative evidence for VAT recovery purposes. So particularly worth looking at if you do incur quite chunky bits of VAT where you might not have the appropriate evidence, and therefore you are in theory delaying the VAT recovery until a later date. In order to get that VAT invoice that will enable you to pop on the VAT return. So it's just thinking about, stepping back and thinking about VAT from a cash flow perspective, and trying to determine whether you are either minimising the output tax that you need to pay at a particular time, or trying to increase and maximise your VAT recovery, and looking at smart but simple ways in which you can do that in a finance context. So as I said earlier, COVID has been very interesting times, and actually it's put more of a focus for many retailers on supply chain. So we've been having conversations with people around, well, what happens if I can't get my goods out of X country because they're locked down? Can I look at a different warehouse in a different country where I normally source goods in respect of my supply chain in a different way? And what could that mean from an indirect tax and maybe customs duty perspective? So I think COVID has really brought about a revised focus on supply chain, and the importance, and well, it's definitely driven the importance about having conversations and knowing what your supply chain looks like and how it's mapped, so that you can manage your stock appropriately and move goods in and out of different locations where you may not normally source, especially moving from a bricks and mortar retail environment to more of an online, more fluid environment where you are making sales remotely to consumers and moving goods about. I suppose my word of warning with regard to that is sometimes logistics and businesses will make decisions around moving stock and moving goods, might not let the tax department know about that until a later date. And obviously, if you are changing your supply chain, then that may bring consequences from a VAT and customs duty perspective. At the moment, whilst we're in the EU, it's pretty flexible. The reporting is fairly straightforward, especially on a business-to-business context. If you have, or if you know that you have made significant changes with regard to your supply chain, it's definitely worth considering whether you have applied the correct VAT position, and whether it may lead to other areas of tax needing to be looked at in a bit more detail. So obviously that's looking back, and I think the key message with regard to the last 6 months is that it's been really quite tough, and businesses have had to be quite innovative with regard to their supply chain, how they deliver their goods to the consumer, and therefore you need to start thinking about that in a wider context. I think as we move forward to 2021 and Brexit, in some ways it's almost dovetailed. So I think I've been talking to retailers for quite a long time around mapping your supply chain, knowing where your goods are. Do you really know the impacts that it will have on the business with regard to Brexit? And with regard to VAT, typically you won't have a VAT cost in most situations, but it often comes with an administrative requirement. And that gets much more difficult as we move forward to a post-Brexit environment and not being able to move those goods freely within Europe. I think the other thing to remember, just quickly on that last slide, is just the fact that at the moment we do rely quite heavily on EU-wide simplifications. So things like holding stock in other countries for call-off or consignment to particular consumers or businesses on a wholesale basis. Those rules will change in a post-Brexit environment, and it will mean that if you're holding stock in other countries, whereas we can switch the VAT liability onto our customer, for example, in a number of cases, those easements will go. So we now have to start thinking about what does that really mean for my business, and in a retail context, does that mean that I will be liable to be registered? Do I need a fiscal rep? What does it mean with regard to business to consumer sales? So as one of the simplifications that we have in the UK at the moment is around distance selling. So we can rely on the European distance sales rules to account for VAT on a business to consumer basis on online delivered sales in the UK, for example, where you are established as a retailer, and only have to register and account for VAT once you breach the threshold that may apply in the other member state. Now, in a post-Brexit scenario, and I'll come on to a couple of examples in a minute, the benefit of using that simplification will go, and that will mean there will be wider consequences with regard to the registration position, the holding stock in different countries. So if you haven't already started to think about, as Håkan said, January is going to come pretty quickly, and we need to start thinking about these rules now and making sure that we are ready come the changing rules that will apply maybe next year. Next slide, please. So what I've done here is I've tried to, because the VAT rules sometimes seem a little bit more complex in a business to business and business to consumer perspective for retailers, what I've tried to do in the next couple of slides is just try to illustrate the position in a pre-Brexit and post-Brexit situation. So try to bring a couple of those scenarios to life and to give you a few things to think about with regard to what's going to happen next year. So with regard to the first slide, so this will really focuses on the suppliers on a business-to-business basis. So, for example, if you have a situation where you might be a UK business selling goods to a business in another country. So that might be the situation whereby as a retailer, you have a bricks and mortar shop in the UK and you hold goods in a UK warehouse, but actually you also have a store, say, in Germany, and you wish to move goods at the moment from the UK to Germany. So what would the position be in a pre-Brexit situation? So at the moment, as I say, it's relatively straightforward. You can move the goods pretty freely. From a VAT perspective, you would treat the movement of the goods and the sale of the goods from the UK retailer to the German customer, business customer, as a dispatch in the UK. You're allowed to zero rate that supply. you would have to report that on your VAT return. It would be a zero-rated transaction. And provided that you obtain your EU customer's VAT number, there wouldn't be any UK VAT on that charge. So the receipt of those goods in Germany wouldn't have UK VAT on it. Instead, the German business customer would self-account in Germany under the acquisition VAT rules for those movement of goods. Now that's great, and that's fantastic in respect of no obligation for the UK retailer to have to register for VAT in Germany. And all of the accounting is done in Germany by the recipient. So very nice and easy, fairly straightforward. In a post-Brexit situation, the movement of those goods from the UK to Germany in that example would have to be reported as an export from the UK and an import in Germany. Like Håkan said earlier, when we're moving goods in an import-export position, we're going to have customs duty declarations, and we're also going to have duty payable and import VAT payable in the country in which the goods are received. And the whole question there is, who is going to be responsible for the import? So the export's pretty simple. So it would normally be the retailer in the UK in this example that would be the exporter. So they would complete the export documents to send those goods out of the UK to Germany in that example. Again, zero rated, provided that we can prove that the goods have physically left the UK. And there are much tighter restrictions around documenting proof of export. And we've seen a number of challenges by HMRC around evidence for export in that respect. As I said a minute ago, the key thing in a business-to-business situation is the question of who is going to be the importer of record. If it's you as the UK retailer, the first question is that possible from a customs duty perspective, and do you need to have a European EOR number, a customs duty number, to enable you to import into the European country? Another point around, if you are the importer of record, you're obviously going to be responsible for the customs duty payable and the import VAT. Import VAT is typically recoverable on a local VAT return. So then you'd have a domestic supply in Germany, more reporting requirements, and maybe in some cases a fiscal rep requirement to actually allow you to register and allow you to file VAT returns locally where you have no physical presence. So slight change in respect of B2B. As I say, the key thing here is understanding who is going to be the importer of record. If it's your customer, it's great because you've exported and you don't have to think about any customs duty declarations for the import or any local VAT requirements. But it's important to make sure from a commercial perspective that you get your terms and conditions really clear to ensure who, and make it very clear about who is going to be incurring that cost. In respect of the supply chain and what you can do to avoid that. So business to business sounds fairly straightforward. I think compared to the business to consumer scenario, it typically is. In a business to consumer scenario, here we're looking at delivered goods. So as I said a moment ago, in respect of a couple of slides ago, so if you're selling goods on a business to consumer basis at the moment and they are delivered goods, then you can rely at the moment on the EU distance selling rules. As a reminder, that means that you would only have to VAT register in the UK, which you would be anyway. You would account for VAT in the UK in respect of all of those B2C sales until the distance selling threshold in the member state has been breached, and then you'd have a liability to register. Obviously, at the moment, you don't have to have a fiscal rep in the local country in order to file the VAT return. So whilst it is slightly onerous, once you've breached the distance selling thresholds, the actual process and the declarations are not too bad in theory. In a post-Brexit scenario, you will lose that simplification. So we revert back to maybe the B2B scenario, and we would have an export from the UK and an import into the European country in which the consumer is wanting the goods to be delivered or where they belong. So as I said a moment ago, this will mean that you can't rely on the distance selling rules. So if you're sending those goods from the UK to Germany, you would have to export them from the UK. Export documents would need to be completed and submitted. And then the question again comes as to who is the importer of record. Now, from a commercial perspective, it's been a long established practice that in a UK to non-EU situation under the current rules, a lot of retailers take the position either that the consumer is the importer of record into those local countries, and that enables them to avoid the need to register and account for the local VAT on a domestic supply, or in some cases the UK retailer will again make the consumer the importer of record in the non-EU country, but in respect of the terms and conditions, what they might agree is that they will effectively arrange for the freight forwarder to pay the duty and the VAT locally on their behalf. Now, in a European perspective, that's never been the case, so we've never really had to worry about who's going to be paying for what. But I think, again, in respect to supply chain and retail going forward, I think it's all about experience and it's all about what the consumer expects. And if the consumer is the importer of record, it will be the consumer that will have to pay those costs when the goods come into the country. So effectively have to go to the post office to collect the goods, pay the duty before they are released, depending upon the local rules in the home country. But it's really important to start thinking about that change now. Now, some of our retail clients have been thinking about whether they can remain in the EU. So can they look at setting up, for example, a German or a Dutch establishment of some sort that would enable them to sell delivered goods from that location? And what would that mean? So we are seeing a slight split in respect of the post-Brexit model, whereby goods are coming into the UK for a B2C sale, for example, but maybe goods may remain in Europe for that B2C transaction. If you're able to sell delivered goods from Europe still, it will mean that you can rely on the European simplifications. Now, another thing to have a think about is come middle of next year, the distance selling rules across Europe will change again. So whilst there still will be a requirement to have to pay local taxes, the European Commission are looking to introduce a mini one-stop shop position. So whereby you'd look to register in one country, normally in the country in which you're established, and you would file a single VAT return that had the multiple countries on that VAT return. So making VAT filing within the EU much simpler and much more straightforward, albeit still having the position of having to pay local taxes where due. So I think on a online selling position, there's quite a lot to think about with regard to, do you change your supply chain? Do you have an EU versus UK versus rest of the world model? And thinking about what does that mean? You'd always want to do that in the context of trying to mitigate VAT and tax leakage, trying to avoid that double dip customs duty position that Håkan was speaking about earlier. So yeah, we don't have much time as we head towards 2021. So if you haven't started thinking about it, it's definitely the right time to do so now. Right, so that is me for now. I'm going to hand you over to Julia, who's going to talk you through some of the international tax and transfer pricing aspects with regard to cash and the way forward for the next year. So
thanks,
Julia.
Martine. Thanks, Martine, appreciate that. So I'm now going to cover key areas of retail supply chain change where I'm getting involved from the perspective of international corporate tax and transfer pricing, and focus on some specific actions that I think retail groups should be considering. I want to start with COVID-related transfer pricing adjustments. Clearly, we've seen dramatic changes in the economic environment in the last 6 months, and a number of multinational groups, including retailers, are currently reviewing their transfer pricing arrangements. Transfer pricing policies were set in more settled time, and the question is, are they still appropriate in today's environment? Groups that have been highly profitable might have moved into loss positions, and therefore considering how is the pie shared across the key members of the group. And often we're seeing that the analysis leads to the conclusion that there ought to be changes in intergroup payments. And this can actually bring cash flow benefits to the group too. So for example, just as commercial teams are reviewing contracts and renegotiating third-party royalty or franchise arrangements, groups may consider that similar behaviour is appropriate for their internal arrangements, and doing the work to identify whether it might be appropriate to reduce intergroup royalties, intergroup franchise amounts, or even whether a payment holiday can be justified. In the same way, groups are also looking at their intergroup product pricing and the transfer pricing that's been set. The key point I want to make here is that in the retail context, product is often dutiable. So it's important that when this analysis is being carried out, groups consider not only the cash flow and corporate tax consequences of transfer pricing change, but they also think about any associated VAT and customs implications. So retailers who are looking at whether intergroup product prices needed to be adjusted down, or even in some cases up, they might be looking at whether these are retrospective or prospective. They might be looking at whether adjustments are incorporated into future product pricing, whether even one-off payments need to be made, in which case the characterization is important. So it's very important here to make sure that you've worked through what might be the customs and VAT implications. An upward adjustment could increase customs or import VAT, and if there's a downward adjustment, is there possibility to claim a repayment? And in both cases, it's important that appropriate tax risk management is carried out, because it is likely that the customs authorities will review changes in product pricing to be sure that they can be justified. And this is not only on product pricing, it's also important to think about intergroup royalties or other intergroup payments, where those payments are part of the dutiable costs. Transfer pricing changes could also therefore lead to duty changes. We are expecting OECD guidance in this area in the next couple of months, but I know it's something that groups have been looking at immediately. So my main messages are, groups are reviewing their transfer pricing policies in the light of COVID. This can bring cash flow opportunities, but it's important to think not only of the corporate tax and transfer pricing aspects, but think more broadly in terms of managing potentially associated duties and other indirect tax implications. So consider the need to adjust intergroup pricing, identify how the adjustments will be made, prepare for the customs and VAT implications, and really importantly, document the decisions that have been made and the analysis that supports it. I now want to move to business prompted area of supply chain change. And the first is to the fast changing geographic footprint that many international retailers are coming across. So in the post-COVID environment, I've seen a real shift in focus from an overriding objective of efficiency within the supply chain to one now of resilience. And that means groups are working really hard to build flexibility and agility into the supply chain. So as an example, I'm seeing retailers rapidly sign up new suppliers in new territories. Martin and Håkan have already made the case that it's very important to document the changes to supply chain footprint as there's new locations of supply, new shipping routes and new warehousing arrangements. But it's also important to think about the footprint change from a corporate tax perspective. We're particularly seeing this in terms of increased international inventory holdings or more territories where group need warehousing functions. And this is happening partly because of COVID. So for example, inventory might get stuck in different territories. It's also because supply chain teams are looking to have more localized inventory holdings to preempt any potential future blockages. With Brexit fast approaching, we're seeing stockpiling either side of the channel again. So the corporate tax risk assurance exercise that needs to be carried out is to confirm whether the new in-country activity associated with inventory holdings or warehousing arrangement might be so significant as to represent a new taxable presence. And that can happen even in the case of third-party arrangements. Or if warehousing activities are conducted in-house, is there an implication for existing transfer pricing arrangements between group members? So I'm working with a number of retailers at the moment to review the new inventory holding activities expected, and in particular to review contracts with new third-party warehouse providers so that they can assess the risk of the creation of a new taxable presence in a new jurisdiction. As these risk assurance exercises are carried out, it's important to remember that the OECD BEPS initiatives had a material impact on the definition of local taxable presence. We're now seeing the multilateral instrument adopted in many countries, so the BEPS changes can actually now be incorporated into the double taxation treaty network. So the first challenge is to make sure that you know whether you're dealing with a treaty that has changed or whether you're dealing with the old treaties. One particular change that is considered when people are looking at inventory activities is around anti-fragmentation. And that is whether, when looking at a presence in a jurisdiction, looking not just at activities on standalone, but considering the cohesive business operations in that territory. Now, these are new international tax concepts, and we don't yet have a lot of certainty in how local tax authorities will interpret them. So as you're looking at the taxable presence, this will introduce some new areas of uncertainty. The last area I just wanted to mention on footprint change, it's not actually retail specific. I'm seeing it in all international groups. It's not just supply chain specific. And that is, so many people working from home at the moment. We're seeing many employees wanting to work outside the territory of their employer. And so just a suggestion that it's worth making sure that within your risk management policies and procedures, you're now reflecting increasing homework and have a policy to deal with that when that's outside the jurisdiction of the employer. At the start of lockdown, many tax authorities gave comforting statements, but clearly 6 months in, it's an important risk management activity. So the actions that I'm recommending here are ensure that finance and tax are closely integrated into any supply chain planning and change. As Håkan and Martine said, map supply chains carefully. Think about VAT and customs, but also identify changes in geographic footprint. The final area that I want to pick up is around innovation for retailers. Martine's already discussed the move towards e-commerce. It's very important that as international retailers move into international e-commerce, that they've understood the implications for local taxable presence on that. We now have digital service taxes, which can impact in the UK, particularly if you've got exchange platforms. And just a quick plug here for the BDO Digital Service Tax Tracker. It's a very helpful summary of the various digital taxes in different jurisdictions. Finally, on innovation, many multinationals at the moment are very focused on looking at R&D tax credits. It's an important potential cash flow benefit if they are involved in innovation that might qualify for R&D. And that's no less important for retailers. So retailers are considering genuine innovation, not only in product development, but actually also in their front-end e-commerce platforms and their back-office supply chains logistics solutions. So this could really help your business. So in innovation, really important to understand business model change, particularly around e-commerce, how e-commerce activities interact with existing bricks and mortar operations, plan appropriately for any new IP development and exploitation, design the transaction and TP model for new and adjusted e-commerce operations, and then finally consider the potential for any R&D tax credits. So I want to finish at that point. Håkan, was there anything that you wanted to add at this point on EOR numbers?
Yes, thank you, Julia. Yeah, it's a question I get often from my clients related to what Martine was saying about that establishment, but it's about EOR number and what you need as a UK company to be able to be importer in the EU, and especially when you talk about, as Martine did there, about B2C sales. So you're selling online, but your stock is in the UK and your customer is sitting somewhere in the EU. You don't really want to make the customer force them to be the importer for cost and just convenience reasons. So what do you then need to do? Well, it's not very simple and straightforward, unfortunately. So really what you need to do, you need to look at several things. You need to look at the PE risk if you decide to establish yourself in a member state. So that's what Julia was talking all about. There's also about the logistics, that what makes sense from a practical point of view. If you want to move goods from UK into the EU, what ports are we talking about? Where are goods going to arrive in the EU? So that's another consideration. And then each member state will have their own definition, really, or own interpretation of what it means to be established from a customs point of view. the customs law is clear. It says that to be established from a customs point of view means that you're carrying out customs activities in that country. But in reality, member states will have different thresholds for what they consider to be, you know, enough customs activities. Some member states, you might need to have people on the ground. Other member states, you don't need that, but you need to have some kind of activity happening, some kind of customs related activity. So it's a complex jigsaw puzzle with many pieces. But I just wanted to mention that's a question that comes up more and more often now, and understandably so. And the answer is not always straightforward.
And Håkan, I would just add to that in respect of the point you made around different definitions of being established. So again, the VAT rules will be different, the corporation tax rules will be different. And I know, Julia, we've been having a few conversations around the change in establishment rules around warehousing, for example. So quite important to make sure that if you're asking questions around, do I have enough from a customs perspective to be seen to be established so that I can import goods into the EU post-Brexit, that you mustn't forget about the fact that the establishment rule may mean that you could bring the VAT position into play, and also other taxes around the corporation tax and being seen to be established in countries that you weren't previously established in. So often we look at the advice for our clients on a holistic tax perspective, covering all bases, because you don't want to fall indirectly into a position whereby you tick the box from a customs perspective, but you also get yourself into a little pickle around the corporation tax position. So we all work very closely together in respective projects to ensure that our clients don't fall foul of any of the taxes in that regard.
Thank you both. So that concludes this afternoon's session. I'd like to thank everyone very much indeed for joining us on this. The recording is going to be made available a few days after the call on our website, and I anticipate that we'll be having many more discussions on these areas over the upcoming months. Thank you very much, everyone.